Hello, welcome to a special edition of Your Wealth Matters. We are pleased to have Glenn Murray, President and Chief Investment Officer at Capstone Asset Management, with us today to share his insights and views on the current real estate markets and how they relate to Capstone's mortgage strategies. Welcome, Glenn. Can you give us your brief thoughts on the markets in general, as well as the construction industry in particular?
Thanks, Shannon. Yeah, I'd be happy to. It's been a challenging year as we deal with various issues of inflation, increasing interest rates, and significant geopolitical concerns. Adding further to these issues, many have experienced investment challenges in their broad investments as these issues have played out in both the stock and bond markets. As of Thursday, the Canadian market was down over 13% in the broad Canadian bond market, and I measure that with the XBB, which is an exchange traded fund. It was also down around 11%, which really is indicative there's no place to hide, and particularly within a traditional equity and bond allocation. At this point, the Canadian Central Bank and the US Fed continue to indicate there will be further interest rate hikes. And with the growing expectations of a global recession, we're seeing ongoing volatility in both markets. Focusing more on real estate and specifically the construction industry, it is fair to say that it too has been impacted by inflationary pressures and the rise in interest rates. Projects have experienced pricing pressures during the year as we saw commodity pricing soar in the early part of 2022. On a positive note, pricing in the commodity markets has been coming off for a few months, and there are some areas of construction like lumber where those price reductions are starting to come into the market, which will help if it continues and broadens out. Interest rates or financing costs for developers has been a pressure point, as many construction mortgages, including many of ours, have a variable rate that uses a prime plus model. So with interest rates increasing, there's been a direct increase to borrowing costs, which has impact on things such as contingency reserves, and potentially ultimately requires either equity infusions or additional financing. I've previously discussed in these forums that we watch several factors with respect to the real estate market. These are things such as interest rates, unemployment, economy, and immigration. Now, obviously, interest rates are an issue causing pressure. The economy is also under pressure due to both interest and inflation rates. But unemployment rates continue to remain low, although the last couple of months we have started to see some cracks here. Additionally, immigration into Ontario in the second quarter was a record inflow at over 105,000 new people moving into the province. And although we're seeing inventory levels of homes increasing in 2022, the process and red tape involved in getting new product to market is still quite significant. So there are pressures facing the industry currently, and I would say these pressures in the short term outweigh the tailwinds that likely create a baseline to the overall market. Overall, though, our mortgage strategies have held up well during this climate, but certainly with lower returns than our historical average. However, a mortgage pool has performance of 5.35% through the first 8 months of the year, which has added value relative to the broader markets and provided diversification within our clients' portfolios.
Thank you, Glenn. Those are great comments. You had mentioned the overall performance was lower, and clients saw in August that the distribution was a bit lower too. So can you give some context to this?
Yeah, that's a great question, as there can be some confusion when people see interest rates rising. The performance is influenced by many different factors on a month-to-month basis, with some of those factors being positive influences and others being negative. So on the positive side, most of our mortgages have a variable rate. So the fund has been seeing increases to the rates on the portfolio holdings, which has increased the overall yield being received. This, however, can be a two-edged sword, as increased rates potentially put some pressure on the developer's margins, necessitating the need to remain vigilant even as income is increasing in the portfolio. In addition to the increasing rates on existing mortgages, we can also put money to work in new projects at higher rates. In this type of climate, the new opportunities often allow us to lend to borrowers with even stronger projects as they seek larger margin in this current market, which strengthens our overall portfolio. However, what we have been experiencing, particularly in the latter part of this year, is a significant slowdown in the timing of capital being called to fund projects we've already approved. So this slowdown is a result of several different factors. Some factors dating back to issues from COVID, other factors such as lenders in the debt stack taking significantly longer on decisions or adjusting decisions and demands, and then obviously developers are constantly working through changing cost structures. All of these have played a role in an increased timeline from approval to funding. The result of this has been a growth in the cash drag on the portfolios. This has been particularly frustrating as most of the cash within the portfolio has been allocated and is awaiting the call to fund. This reinvestment delay is further accentuated by the fact that some of the maturing mortgages in the portfolio had higher yields on them. An additional factor of the current market is the need to increase that bad debt allowance when we see potential areas of credit weakness in the portfolio. Overall, this is a typical part of investing in the construction and development industry and not new to our funds throughout their history. So as a result of these issues, our performance has tracked behind our historical numbers and was evident in the August distribution. With what we currently know and what we expect over the short term with the timelines of capital calls and current market pressures, we expect it to be a few months for this to settle out and normalize.
Thanks, Glenn. And the next question is one we're getting asked more and more of our clients, and that is, why should I continue to invest in mortgage strategies when GIC rates are becoming higher?
Sure. I believe this is a question that typically is individual specific. So in other words, the answer to this will likely be different for different people based on personal circumstances and investment objectives. New GIC rates are set based on the current bond rates. So whereas you could get a one-year GIC currently in the 4% range that wasn't available earlier in the year, and therefore performance cannot be compared or fairly compared between GIC rates and mortgage pool performance on either side of that argument. The mortgage strategies offer a risk premium due to the underlying nature of the investment and will typically outperform a GIC, which doesn't have the same risk profile. So over time, a performance-based comparison will see the mortgage strategies coming out ahead due to the differing risk profiles. In addition, our fund strategies, particularly the mortgage pool, continue to offer better liquidity than a one-year or longer GIC. Finally, GICs provide a fixed rate and a defined maturity versus a variable performance and monthly or semi-annual liquidity, depending on the mortgage strategy. So overall, despite the current market conditions, there are still some fundamental reasons why the real estate market has been strong for so long. 2021 was an obvious temporary market distortion and unsustainable. So a pullback in the market was both likely and probably necessary. Going forward, we would expect the mortgage strategies to outperform GICs at their current rates over time. And by locking into a specific rate, you could miss out on outperformance in the same way you would have by locking into a GIC earlier this year. But as mentioned, that is very much a circumstance-specific evaluation and something I encourage our clients to speak to the two of you about.
Well said. Thank you so much, Glenn, for your time today. And yes, we do encourage clients to reach out to us directly if you have any questions or want to discuss these matters. In the meantime, we hope that this has been helpful, and please stay tuned for our next edition of Your Wealth Matters, where we'll be reviewing the third quarter and getting an update from our newest portfolio manager, Paul Carter. See you soon.